3 weeks ago, South Korea had one of the hottest AI trades in the world. Its stock market had gained more than 50% this year. Then it dropped more than 20% in roughly a month. This video from yesterday, which is a great video by the way, explaining the crash, crossed 1 million views in about a day. So clearly, people want to know, is America next? But I think that's the wrong question. The better question is, if the AI hype disappears tomorrow, what still makes money? So I picked 3 AI businesses. One is basically already dead. One looks like a winner, but could secretly be a terrible business. And one survives even if the models get cheaper and the money gets tighter. And I'm going to score all 3 of them in real time. If you're investing in AI, vibe coding your first product, or you just don't want to get cooked by the hype, this is the test that I would use. Real quick, if we haven't met, I'm Wadood. I work on AI product experiences at Microsoft, and I've worked on Copilot and M365 systems that serve more than 1 billion requests a day. I also co-founded a venture-backed AI company that has helped secure millions in salaries for aspiring tech professionals. So I've seen massive scale AI and the startup version, where everybody loves the demo until you ask for a credit card. These are my personal views, and it's not a prediction or a stock recommendation. This is a survival test for AI businesses in 2026 and beyond. Here's the important part of the Korea story. Samsung Electronics and SK Hynix carry enormous weight in that market. AI data centers need memory. Demand rises, those stocks rise, and investors chase them. But then borrowed money makes that bet even bigger. And that works beautifully. It proves something more useful. Good technology and a fragile investment can exist at the exact same time. And AI builders are making the exact same mistake. The investor says AI is growing, so every AI company wins. The builder says the model can do this, so this feature must be a business. Nope. Capability is not value. It is raw material. Let's meet contestant number 1. Contestant 1 is the generic AI writing app. You type in a topic, it gives you a blog post, an email, maybe 12 LinkedIn posts about how humbled you are. Can you vibe code this in a weekend? For sure. Can it produce a great demo? Yep. Can ChatGPT, Claude, Gemini, or customers' existing software absorb it? Also yes. And that is the problem. So here's our scorecard. 5 categories, 0 to 2 points each. Demand, 1. People need content, but have many ways to make it. Dependency, 0. One model update can erase the reason this app exists. Distribution, 0. Hundreds of similar products want the same customer. Differentiation, probably 0. Same models, similar prompts, similar outputs. And then dollars, 1. It can make some money, but the price pressure here is going to be brutal. Now let's be honest. Specialized writing can survive. Medical documentation inside of hospital systems is not some make me a blog post, but the generic version, its product did not become worse. Its reason for existing became a button. So if your strategy is OpenAI somehow never is going to notice this obvious use case in the corner, that's not a strategy. You got a prayer with an API key. Okay, contestant number 2. It's an AI clipper, and it's much more interesting. You upload a long video, AI finds moments, reframes them, adds captions, and produces shorts. I use these today. Editing takes a lot of time. Distribution matters, and creators are already kind of paying to solve this today. So this one you would think is just going to survive right off the front. I don't think so. What does best clip actually mean? Is it the loudest sentence or the moment my audience will watch, share, and click? And what happens after I process the backlog? Do I keep paying every single month? Then you have transcription, rendering, retry, support, and then captions are a whole nother piece. So let's score it. Demand is 2. Solid. The pain is real. Dependency, 1. Models help, but competitors can access similar capabilities. Distribution is 1, because creators are reachable, but this is a somewhat crowded market. Opus Clip has really proven themselves here. And then differentiation, 1 for now. Editing workflow helps, but automatic clipping itself becomes somewhat common, right? Dollars, 1. Rendering costs and weak retention can quietly eat the revenue. So 6 out of 10. And this is the contestant that I would watch most closely because it can move in either direction. If it only creates more clips, it becomes another feature. If they learn from their audience and their publishing and their performance and all the good stuff on the back end, you can get to a really compelling business. And I do see how Opus Clip is starting to do that with some of the intelligence that they're bringing on the back end. Revenue proves if somebody's going to try it, and if they have tried it. Retention and margin are going to prove if it deserves to exist. At this point, the 5Ds are pretty simple. Demand, do people need the result without AI powered? Dependency, can the model provider replace you? Distribution, can you actually reach customers? What gets better or harder to copy? And dollars, after every ugly cost, do you make money when the customer succeeds? An 8 to 10 here is resilient. A 5 to 7 is probably exposed. 0 to 4 is a cool demo wearing a little business costume. And this isn't going to be something that you can use to value stocks. So don't go and buy weekly options using this YouTube scorecard and then tag me in the aftermath. All right. So the final contestant, imagine a product for a small service business with overdue invoices. It connects to their invoicing system automatically with permission, of course, checks for late payments and customer history, and then drafts follow-ups, gets human approval, records responses, and schedules the next action on the owner's behalf. That may sound less exciting than build your own autonomous agent army, but that's a good thing. The customer doesn't want 17 agents. They want a $12,000 invoice paid, and that completely changes the score. Demand here is going to be 2. Businesses hate chasing money they earned. For dependency, it's a 2. You can change the underlying model because the workflow matters way more than the model or the prompt. Distribution is solid. Accountants, I'll give it a 2. You have accountants, bookkeepers, and payment platforms that can all be channels. Differentiation, also a 2. You have integrations that exist today, history, approval rules, and the outcome data that can probably improve the system. And then dollars is 2 for sure. If the customer is going to collect thousands of dollars sooner, your price is going to be much easier to justify. So I give it a 10 out of 10 on the design of the business. It doesn't guarantee success. Security, integrations, communication, and distribution are still very hard. But notice the difference. The writer generates an artifact. The clipper assists in a workflow, but the invoice product completes a valuable outcome. And that is the latter. As AI capability becomes cheaper, generating another thing becomes less impressive. Closing an expensive loop remains valuable. So if I were vibe coding a business this week, this is what I would do. First, pick one ugly, expensive problem for one group. Not marketing. That is literally a planet in its own. Maybe something like overdue invoices for residential contractors in the Midwest is specific. Second, talk to 3 potential customers before adding another feature. Ask them to show you the last spreadsheet, email train, and ridiculous workaround involving 3 browser tabs and somebody named Kevin that got it done. Third, remove AI from the pitch. Don't even say agentic or multimodal or intelligence or anything. They're going to have no idea what they're buying. Say, we help contractors collect overdue invoices faster without spending Friday afternoons chasing customers. Fourth, map the loop. Information, human approval, completed action, and what happens when AI is wrong. And fifth, ask somebody to pay, not join a waitlist, not comment fire emojis on the launch post. Payment turns, this is awesome, into a much more honest conversation. Now let's bring this back to the market. There are 2 broad ways the AI cycle can go. Scenario 1, AI spending grows and Korea's correction stays contained. Great. Generic wrappers still get crushed because platform features are going to improve faster. Scenario 2, money tightens and companies demand clearer returns. In that world, generic wrappers get crushed even faster. Notice what survives in both scenarios: a painful workflow, real distribution, healthy economics, and a paid outcome. South Korea did not prove AI is over. It proved that real technology can attract fragile prices, fragile leverage, and fragile businesses. Investors see AI growth and assume every AI company deserves a premium. Builders see powerful models and assume every AI feature deserves a company. Neither is true. So don't stop building with AI. I'm definitely not stopping. I'm accelerating. Just raise your standards for what deserves your money and your time. Remember the latter. Generating an artifact is easiest to replace. Assisting a workflow becomes real value. Owning a paid outcome is where the real business starts. And here's my challenge for you. Describe what you're building in one sentence. You can't use AI, agent, automation, chatbot, cutting edge, or revolutionary. Put it in the comments. I'll take some of the strongest and probably a few of the most dangerously overhyped ideas and see if we can run them through the same survival test in one of my next videos. Literally nobody knows the exact date when hype turns into a correction. Anyone giving you the exact date is guessing or selling something. But after the hype disappears, useful products do not disappear. They become much easier to see.